how does pricing really work?
You may not launch your best units in the pre-launch.
So what are some tips and tricks that you have seen seasoned developers use to ensure that things are as planned?
Capital without control and monitoring is a
Yeah.
recipe for disaster.
How much money, putting it very crudely, do they expect to make?
A lot of developers, and I'm seeing the same mistake in the third cycle that I'm seeing in my lifetime of real estate.
Yeah. But can you give us an example, Kuldeep, where you have invested and lost money and invested and made more than you expected to make?
So intent, ability, track record, become important on what I would look for. On the red flags,
how does a developer make sure that the project is going to be viable?
So first we tell them that, real estate is a marathon, not a 100-meter dash.
When you're financing a real estate developer, what are the critical aspects you look for and what are the red flags?
RBI does not allow you to use that money for buying land.
What about debt financing?
If you fail to plan, you'll plan to fail.
How do they select a project? Do they first find the land? Do they conceptualize it and then seek land?
I think some of the construction delays are happening and perhaps will continue to happen in the next couple of years is because we're seeing a massive boom in construction.
So we say that a project is pre-launched or launched or even complete. What does that mean and what approvals have to be in place for any of these to have happened? Kuldeep, welcome to the Property Angel podcast and thank you for making time for us in your very short trip to Bangalore. You've, of course, had a very accomplished career. You've been the CFO of Purvankara. You've also managed large real estate funds at RedFort. So you've been on both sides of the equation of real estate financing. You have raised capital as a developer and you have also financed real estate projects. So no one better than you to talk to us about real estate financing, which is our topic of conversation today. So most of us understand real estate financing as taking home loans for our properties for which we pay exorbitant amounts of money to developers. But here we are trying to understand things from their perspective, right? So before we start the crux of the conversation, let's just understand some terms first. So we say that a project is pre-launched or even complete. What does that mean and what approvals have to be in place for any of these to have happened?
Okay. So I think let me actually start by saying that because when you say of launch and pre-launch, what you mean is strata selling, or individual unit selling in either residential or commercial. I'll use the residential example because that's more familiar for people with home loans and stuff like that. Before a project is pre-launched, under the current rules, RERA does not actually allow you to pre-launch.
But you still hear developers saying pre-launch, how is it possible if data doesn't allow that?
So what typically happens is most of these people are actually using the post-RERA pre-formal launch period as a pre-launch. Okay. Now, for approvals even for the pre-launch to be done, you need to have the land in place, bought, registered, or joint development agreement signed. You need all other, both what we call discretionary as well as non-discretionary approvals in place, which would include but will not be limited to, and as applicable depending on the market in which they are. That would be approvals related to environmental clearance, height clearance, for for supply of water, electricity, access, therefore road and traffic permissions, building permissions, so on and so forth. I think the list is very long, but suffice to say that, all approvals need to be in place, including but not limited to RERA approval for you to be able to even do a pre-launch. That's term number one. Term number two is the difference between the pre-launch and launch is basically what they try and do is to create a buzz, A. B, very often, developers will run what they call tickets or expressions of interest to basically try and gauge the market. Which is in terms of what the market prefers to buy, what types of units, and at what price. The formal launch will follow. And then you said something about
Completion.
Completion.
So,
So completion is usually given once the buildings are complete, okay, and essentially when the external cladding, doors, windows, which obviously assumes that plumbing,
yeah,
water supply, all that is done,
yeah,
right? Now you don't get a completion certificate until you've done all of that. However, I must clarify that in order to gain time,
Hmm.
and also enable the customer to have time to do their interiors and fit outs, right? What developers would do is, I've got completion, but I am not ready to hand over to you because smaller aspects, but important aspects like landscaping, or amenities may
Yeah.
not entirely be completed, fully completed, ready to hand over for customers to be able to move in,
Okay.
So that typically would be anything between 3 to 6 months.
After
Now,
the completion.
after the completion.
This podcast is brought to you by PropertyAngel, the award-winning property management platform trusted by absentee owners since 2014.
What about the OC? Do you get that after
Occupation certificate is often interchangeable with completion certificate.
Okay. So basically, from a formal perspective, pre-launch and launch is more or less
More
the
or less
same
the
thing.
same, right?
It is just the marketing term used
Correct.
to create a
Correct.
buzz,
Correct.
right?
Correct.
And
Now-
maybe figure out the pricing.
Absolutely. Absolutely. Because what will happen is, no matter how much research you do, and there's not enough of it done,
Yeah.
you might want to launch a certain phase, or not launch it, and you're not sure. You might want to launch a certain typology, whether let's say 2 BHK or 3 BHK or 4 BHK,
Yeah. Yeah.
right? You might want to look at other aspects, but should you launch a large, should you combine phase 1 and 2,
Yeah. Yeah.
or should you not? Because if the demand in pre-launch is very good, then you'll open it. On the pricing front, obviously you're looking to not only determine pricing, but also improve pricing over time. So you
What do
might
you
do a
mean?
pre-launch,
Okay.
right? But you may not launch your best units in the pre-launch.
Okay.
That's the other thing that a developer would do.
I see.
Because, at the end of the day, he has a portfolio.
Yeah.
He would look at an average price. How do I get the average price?
That's why when a project is launched itself, they say a lot of is sold out because they don't want to, I guess, sell their best units at that point in time.
No, there are two parts to this. One is that because you are giving a customer a home, an aspirational product, you want there to be a certain buzz. This is a sentiment driven business.
Yeah.
So if as a customer I hear, oh, sold out, that means other people are buying.
Yeah.
Right?
Yeah. Then it's FOMO that kicks in.
FOMO kicks in.
Yeah.
Right? So we all use sentiment,
Yeah.
right?
Yeah.
Don't we do that with cars?
Yeah.
So it's a function of the product.
Sure. So let's talk even before pre-launch, right? So
Sure.
let's say a developer has to launch a project. They want to conceptualize a project.
Right.
How does that process work? How do they select a project? Do
Okay.
they first find the land? Do they conceptualize it and then seek land? And how do they decide if a project is going to be viable or not? How does
Sure.
that work?
Okay, you've asked about 4 or 5 questions. So let me attempt to kind of, step back and
Okay.
and answer those. An interesting point that you made was, do they find the location and then
Yes.
find the product to
Yeah.
fit that?
Yeah.
Or I'm using product loosely because real estate is no longer a product, right? And we may talk about that later, but that notwithstanding, the second point that you said, which was interesting, and I've seen what I call evolved and good developers do that, which is to go and say that based on our consumer behavior and consumer analysis and research, there is a demand for certain types of homes, right? Since we're talking homes,
Yeah.
right, predominantly. Example, people want child-centric homes. There are some developers who've said this is our forte, right? Elder care is becoming an important point, right?
Yes.
So people are saying that's the theme. I then need to go and find a project, a location, a city, a micro market, features, amenities to fit that.
Okay.
Right? So, but that notwithstanding, I think perhaps the single most important criteria to select a project has to be its location, right? Um, and that is because um, access to infrastructure, which the country is seeing a big boom on, not just for the last 5 or 10 years, but going forward for the next couple of decades. And the second thing is, people want to be close to their place of work for social reasons. You have to look at not just transport infrastructure, but also social infrastructure and soft infrastructure. So things like schools, colleges, hospitals. So whether it is education, whether it is healthcare, whether it is entertainment.
And I guess that's what you meant when you said it's no longer product, because the whole experience matters as well.
That, as well as the fact that if you look at it carefully, whether it is pickleball or pet care areas in developments that we're seeing, it's the amenities. People are buying a lifestyle. Sports facilities, whether it's tennis or badminton courts and pools, are par for the course. Um, what people now want, for example, let's take an example. So if my target market in that area, which is something that developers use before they select a location as well, or when they're deciding what to build in that location. If I have families, young families, with children, then a creche becomes important, right? A wave pool might be a good thing, right? Wi-Fi, right?
Yeah, very important.
Right?
Yeah.
Now, if I'm doing a facility for elderly people, then how far is the hospital? Right? But equally importantly, what are the kinds of shops that I will have? How convenient is it?
Yeah.
So you might want to do neighborhood shopping within that complex.
Okay.
Right? You may want to actually reserve, as you might want to give one apartment away in the sense that you don't sell it. But you have a daycare or even a night care facility with a permanent doctor and a couple of nurses there. A mini ICU if you want. Right? That, I'm not even talking about simple things like, wheelchair access and those kinds of things, because that again is par for the course. Right? I'm saying you look at the next level of because amenities, facilities, are important. Like, you see, providing greenery and, water harvesting and those kinds of things are now, again, like I said, par for the course. Developers are now thinking at the next level, right? Saying, okay, let's say if I have millennials, then I have a different. If I have Gen Z, I have a different category of people. Right?
So a lot of consumer research goes into this whole thing.
So not enough yet.
Not enough yet.
Not enough yet. But I think what I'm seeing is people are spending a lot of time trying to understand their target market, their customer. I'll give you a simple example of what even people started about 10 years ago. They went to people like yourself and said, Sapna, can you come and give us a critique of the kitchen? Because whether your maid uses it or you use it, right? The layout of the kitchen matters. And today I can see a huge difference between people who spend time and effort doing that versus people who kind of just gave it to a great architect to do it. But the architect may have done that work or not done it.
Okay.
So the short point being that if you, okay, let me put it very simply. Real estate developers, many of them, unfortunately, even to this day, are making decisions sitting in a room where the person for whom the decision is being made is not there.
Exactly, which is what I thought, which is why I'm surprised that so much research is actually going into understanding the target market. But I guess the grade A and the top builders
and that's the differentiation, because you're no longer giving four walls and good quality. Because everybody can do that.
That's a commodity now.
Right? So everybody can give you good four walls, good quality, basic amenities.
Yes.
I'll give you another example. We do a lot of work with small and mid-sized developers. So when I always tell people, and I see this, the advertising and the creative that you have, I could change the name and it could be pretty much anybody. Number one. Number two, when you write 30 plus amenities, you can write 100 plus amenities. The question is, what is relevant for your target market?
Yeah. And what's the
Why
USP?
are you not focusing on that?
Yeah. Yeah.
So
in terms of the pricing, right, given that it's so complex and there are so many permutations and combinations of what amenities, what specs, what features you want, how does pricing really work?
okay, pricing is a little complex, but let me put it this way. You have to look at 3 or 4 things, right? Number one, you have to see what size of project you have and what you want to accomplish by way of when you want, what volume you want to sell at what stage, right?
Okay.
Number two, you have to focus on, depending on the product, that it must fit the budget of the customer. So affordability is important. And when I mean by affordability, I'm not saying lower price, right? What I mean is, how are you going to give value to the customer? Because even if it is a home that, let's say, you would buy or I would buy, which might be a 3 to 10, 20, 30 crore home, if we don't see value, we won't pay. And if we see value, we'll pay huge amounts of money. So the point I'm trying to drive is that needs to look at value, okay, and does look at value. And that's why some of the things we talked about a couple of minutes ago are important.
Yeah.
The second aspect is what I said about, how much do I need to sell in what time frame, right?
Yeah.
Because that is dependent about A, how much patient capital I have, right, which is equity.
Yes.
Right? B, if I have, either on the project or elsewhere, debt that needs to get serviced.
Okay.
Right? So this thing. And C, what terms I got either when I bought the land or the terms that I've agreed with my landowning partner.
Right.
So if I need to pay him certain sums of money that I've agreed, then I need to make sure it comes out of the project. Right? So that is one kind of dimension of looking at pricing. The second dimension on pricing is something that I said about a couple of minutes ago, which is I might launch attractive to de-risk the project, sell a certain meaningful volume, right?
Yeah.
And then hold pricing, right? To increase it later, partly because I'm launching more premium units or premium location within the project later, partly because I have now got a stage on the project where there is a certain set of customers who are willing to pay a higher price for the lower risk of time to completion.
Got it. Yes.
Or if I stretch that point a little further, customers who say, I only want to buy completed units.
Yeah.
Or near completed units.
Yeah.
Does that answer your question?
Absolutely. Very interesting. So now how does a developer make sure that the project is going to be viable?
Oh, yes, right? I forgot about
and
that
how
point.
much money, putting it very crudely, do they expect to make at the very minimum?
Okay, so let me answer that second question, because there are two ways of looking at it. On a gross basis, right? I think the margins that developers are usually working with at a project level, okay, not including corporate overheads.
Okay.
But let me say, even if I were to allocate corporate overheads to that, just to kind of simplify the whole thing, at a gross level will be anything between pre-tax, pre-interest level. Okay. Which in finance parlance is called EBITDA, earnings before interest, depreciation, taxes, and amortization, or is in the region of between 10 to 20%.
Okay.
But the median is largely somewhere between 10 to 15%.
Yeah.
Right. Not more than that.
Okay.
In fact, I would even argue that in the last few years where we've seen significant inflation, it's closer to, 9 to 11, 12%.
Wow.
Now, that's the profit margin, but that might be a little misleading because what what a developer would look at is, what is my investment in that project, right? Now, this margin makes sense where I can work for a lower margin if I am getting a high multiple on my investment. Let me articulate that a little bit better.
Yeah.
Let's say that the land is worth 100 rupees.
Okay.
Right? Now, I bought a land for 100. Okay. I spent, let's say, 200 rupees on construction. So my total investment is 300.
300. Yeah.
Right? Now, depending on the velocity of sales, if I can recover my 100, I have to do upfront in land and approvals. Right? But the 200 will largely come from customers. Right? So that's not my investment. Right? Now, depending on what price I launch, what sales velocity I have, if I can recover my 100 quickly, then my equity investment of 100 may come down significantly.
Okay.
Example 1. Example 2 is, instead of buying the land at 100 rupees, I paid only 10 to 15 rupees between the deposit and approvals, because I did what is called a joint development.
Okay.
Right? So my investment is only 15.
Yeah.
Now, if I'm making, now I'm looking at absolute numbers, not at percentage. So in both examples, my construction cost was 200. Right? So in the second example, my total cost is 215. But 200 is still coming from customers. But largely. Right? If 15 is my investment, then if I make total of 45, right? Of profit, because my investment was 15, I made 3 times my money. In the first example, where my investment was 100, right?
And you made,
I will probably make a larger profit than 45. Because, but let's say it's only 200. 100 profit. Right? I've made 2 times my money. But in the first example, I made more money. Number 1. Number 2. Because I have 15 rupees, I can actually do 7 times the 7 projects. Because 100 versus 15 is almost 7 times. So I can do 7 projects.
Interesting.
So the point I'm trying to make is, when developers look at profits, that's the way to look at it. I just wanted your audience to kind of understand this point.
Very interesting. So, and that brings us to the crux of the conversation we are having, which is financing. So, when a developer wants to raise money, right? Let's say in either of these examples, what are the options available to him? At what stages are those options available? Let's look at the conceptualization stage, the pre-launch.
Sure. Let me just address that in the following manner. What is important to understand, and we'll talk right now both commercial or non-residential as well as residential, if I may take that.
Of course.
But first residential, since we've been talking largely about residential. Money is needed at the first stage for you to do a little bit of research, right? But largely to buy land, right? Or to, in the example I gave, to also pay the deposit.
Yes.
Right?
For the JV.
For the JV, JD, joint development, whatever format you're doing. And that's the initial stage. Plus, you need to put up a little bit of money towards approvals, maybe some site work, so on and so forth. That largely should and comes out of equity. Okay. Now in the commercial example case, it's the same, right? Land, right? The second phase, and I'm including approvals in that phase, right? Then you have to put up a little bit of money towards, architect's fee, consultants, site office, Now, depending on your corporate relationship with capital providers, you can get either that through debt or you put in equity. Again, it's not very large.
So this architect and all is at the pre-launch.
Yes, because at the end of the day, if I don't design the project, what will I go and get approved?
Correct. Yes.
Right?
Yeah.
Okay. And in fact, people create options as well, right? So I need to give somebody time, So all kinds of consultants. I will have lawyer liaison, legal work, liaison work, design work, structural work, MEP work. So again, it won't be as, it'll be detailed later, but the basic concepts I still need to do.
Yeah.
Market research, so, and a bunch of other activities. I might be doing site fencing, boundary walls, site clearing, making the sample flat, making the marketing office.
Yeah.
So there's a significant amount of work that needs to go in before you actually launch.
Yeah.
Including but not limited to, doing surveys of various types, including, I'm not talking market, I'm talking of soil, water, traffic analysis. There are so many things that need to get done. How is the sun going, right?
Yeah.
So how am I going to design stuff? Where my amenity is going to be, because we mustn't forget some of these developments are very dense.
Okay.
Right? When you do dense developments, I need to look at how much traffic is coming, ingress, egress, basements, and those, for example, parking is one area where, a lot of Indian developers have a lot to learn from elsewhere in the world. Some of the guys have done it over the last 10, 15, 20 years. And that can create a differentiation.
Okay, like what, for example?
Like, very simply put, I'll just keep it very simple for your audience. I have 3 basements, right? How do I allocate between which towers, right? Who gets to park on the uppermost basement? Right? Number one. Do I create a mess? Number one. Number two, at a different level, I'm saying the use of multi-level car parks versus basements.
Okay.
Should I go underground? Should I not go underground? Yeah. That can determine marketing. So, what I meant by ingress, egress is, what will happen is you need to have done a detailed analysis of how many cars are coming in, and going out at peak level.
Yeah.
Example, on a holiday.
Yeah.
When you have a lot of visitors going in or going out, let's say around Dasara or Deepavali, or depending on which city you're in, so on and so forth.
Yeah. So is there technology available for developers to design all of this?
Oh, of course. In fact, that's an interesting point that you're saying. I think increasingly we are seeing the use of BIM, the use of other technologies to not just design, but also do a bunch of other things.
So coming back to the question of financing, right?
Yes,
so
I
we were
apologize,
talking
yeah.
about what the options are available.
Right,
So
yes.
let's take a look. Let's talk about the land phase. They want to acquire land. What are
Right.
the options available?
So, by and large, equity is used, but also what's available, and certainly to disciplined and well organized developers, and these need not be only category A as we define them, right? Is the use of debt from other projects, right? Which is free to be used, for buying land or for buying part of the land for this new project. Let me give you an example. So there are 2 or 3 types of things. We'll just talk about a couple of them. Let's say, the project is complete.
Okay.
I have unsold units. I've kept them because I think in this location, and I had a good margin on the project. So, now RERA, I finished RERA. No?
Acha.
I can do whatever I want with those units.
Okay.
Correct?
Yeah.
Right? Yeah. Because RERA is over, UC is come, I've handed over.
Yeah.
Those units are mine as the developer.
Yeah.
Right?
Yeah.
So that is option 1. I can sell those. B, I can take money against them. Right? Now, what you won't get is money from banks and now from NBFCs, because that's not allowed under RBI does not allow you to use that money for buying land.
Okay.
But let me put it very candidly. I have a bunch of corporate expenses, right? I can use NBFC or bank money for that.
Okay.
And the money that my equity that I had in it, that I was using for corporate expenses, I can do that. So money is fungible in that sense. Point number 1.
Okay.
Point number 2. There are capital providers who will give me, let's say I have, in RERA, there are 2 accounts that are there. One is a 30% account, which I can use to withdraw money from RERA account for money which I have spent. Let me take an example.
Okay.
Let's say we'll take the same example that we had. 100 rupees I spent for land, 200 rupees I'm going to spend for construction. It's an under construction project.
Yeah.
Right? Let's say that 100 rupees I put as equity. Correct?
Okay.
Now, as per RERA, for every 10 rupees I collect, right, I can withdraw some money because I from the 30% account.
Okay, correct.
For against the 100 of equity that I have put in. Agreed?
Agreed. Yeah.
So that money is available to me to go buy the new land.
Okay.
Now, if I sell this project very well in the beginning, right, I have visibility to cash flow. So a capital provider, let's say a fund or somebody else, is willing to give me money against my good margin, which is going to get accrued over time.
Okay. Okay.
And he gives me what in finance parlance we call a cash out.
Okay.
So he gives me 50 rupees, let's say, right? Because in this example, 300 rupees was going to be my profit, right?
Yeah.
Now, what happens? That capital provider recovers his 50 rupees from the ongoing project.
Okay.
But the 50 rupees which he gives me, I don't need for this project. So I can use that to go and buy land.
Got it.
Or I can use this 50 rupees to set off some other expense, right? And the money which I had kept for that expense, I can use it to buy land.
Got it.
So that is how, otherwise it will be almost impossible.
Yeah.
I'll have to keep putting in huge amounts of money.
Yeah.
So that is point number one.
Yeah.
Point number two, and the same logic applies to commercial, right? The only difference I want to highlight, and if you have time, we can talk about it, is that in commercial, my equity requirement is larger because if I'm going to spend 200 rupees on construction, and my strategy, like a lot of large developers, is to then hold that asset for rental value, then the 200 rupees, the bank may not give me full 200. They might give me 170.
Okay.
So I need to put up another 30 rupees out of a total cost of 300 as equity.
Okay. So when you say equity, let's talk about that. Like, how do you explain equity? Like, what are the sources of funds for equity financing? Is it private equity? Like, what else?
There are two large, broad sources. I would say really three sources. One is, private what is generally called private equity.
Yeah.
Okay. Second is there are private. There are individual family offices and other investors who will invest alongside developers as equity, right? And then the third source is the developer's own money, which might either come from his initial capital, from other businesses, surpluses that he has, which are non-real estate businesses, right? Or surpluses from projects.
Got it.
Right?
Okay. So external sources of funding is basically going to be either your private equity or family offices. Those are
family offices or other investors. There are institutional investors, strategic investors, so on and so forth.
Okay. So what about debt financing? And at what stage does that come in?
Okay. So debt usually, we must appreciate a very simple thing. Let me just explain it to you in a very simple point. Any lender, whether NBFC or bank, right, has no more than 10 to 15 rupees of his own money. 85 to 90 rupees is other lenders' money. So by definition, if 10-15% of their loans fail, they will go bankrupt.
Okay.
Therefore, whether they like it or not, they have to be extremely conservative.
Of course. Yeah.
Right?
Yeah.
Okay. And you and I have our money in those lenders.
Exactly.
So we want them to be conservative.
Yeah.
Right? Yeah. So the point being that they will usually come in because they will look at the developer's reputation. They will look at the developer's track record. They will look at the risk that is there on the specific project or projects that they are financing.
Okay.
Right? Now, banks by RBI's mandate are not allowed to lend for land and can only lend for construction. Right? Or in the commercial example case, they can do what is called lease rent discounting. What that means is LRD. What that means is that if a developer has or the owner of the property has an asset which is giving him rental income every month or every quarter, right? The bank is allowed to give that person, discount the rent for the period of the lease, right? And give him that money upfront. Okay. The reason I mentioned that is that, when developers have a mix of residential and commercial projects, that money, that lease rent discounting can also be used to go and buy land.
Got it. Interesting.
Right?
Yeah.
Now, coming back to the point of debt, NBFCs also are not allowed to use money to give money for land. Okay, so their money would also largely go into the project, either for construction or for expenses, or they can, in select cases, housing finance companies allowed to refinance your approval and other costs. Okay. So debt by and large will come in once the project is launched.
Construction started or not necessarily?
May not have been started.
Okay.
See, because when sales have happened, what is important to understand is, are those sales genuine sales, non-cancelable, or are they just, as we talked about, an expression of interest?
Yeah.
With a token money that is refundable.
Okay.
Right?
Okay.
So a lot of developers do this. And there's nothing wrong with that, because the developer himself is trying to de-risk the project.
Yeah.
You sell a significant amount and then you start construction. Because at the end of the day, if you start construction and your sales momentum doesn't continue, how will you just slow down construction?
Yeah.
Right?
Yeah. True. Yeah.
So, the other, and again, the lender will, let me just step back and tell you that the lender will, what criteria the lender will look at.
Yeah. Let's look at that.
To repeat,
Yeah.
He will look at the developer's reputation.
Yeah.
He would look at the developer's track record. Let me give you a more specific point. Even a lender, even to a category A or a good developer, may or may not give money to that developer going for the first time to a new market.
Oh.
Yes.
Okay.
Because real estate is a very local business.
Very true. And we've seen examples of
even
cases
the big
where
names in Bangalore today get, Shobha, for example, I think 70% plus of its business is still Bangalore.
Yeah.
Even today.
Yeah.
And they've been in business for decades.
Yeah, absolutely. Yeah. So are there a large number of family offices that actually invest in the equity rounds?
Increasingly so.
Okay. And at what rate can developers raise money from banks?
So the construction loans will be, for the best guys, will be in the region of high single digit. And that range is high single digit to about 12-13%.
Okay.
Rate of interest.
Okay.
Right, for construction.
Yeah.
Family offices, obviously, their money doesn't go into their investment is either equity or they will do debt, which could be used to buy land. So those rates are much higher. Those are in the high teens and upwards.
Got it. So let's talk about cost efficiencies, right? So very often when new developers come into the market, they tend to almost lose money on the project, and this has happened. But seasoned developers figure out ways to not overrun their budget. So what are some tips and tricks that you have seen seasoned developers use to ensure that things are as planned?
Okay, so if you fail to plan, you'll plan to fail.
Okay.
So planning, budgeting, God and devil both are in the detail. Okay, so that's point number one. Point number two is standardization. Standardization of materials, systems, processes, and everything that goes with it. Because with standardization, and the third point is economies of scale. Now, standardization enables economies of scale as well.
Yeah.
Right?
Yeah.
So
many new developers
reduces
will come
wastage.
Yeah. Yeah.
Yeah.
Yeah.
So, for example, if the design of this room is such that I can use a 2 feet tile, then my wastage is not there.
Yeah.
Simple point. If my standardization of the faucet is there or of the electrical point is there, imagine that I don't need to have that many SKUs. Right? A fourth point is to do with broadly with technology, which we touched upon briefly, but with things like BIM, the use of precast technology. See, if you were to look at why do cost overruns happen, we must appreciate why do they happen.
Exactly.
So they happen because you've not planned and detailed, right? Number two, because you had just so many items, right? So the point about standardization. And the third, and perhaps as important point as the first one about planning, is time overrun. You have a cost overrun because you have a time overrun.
Exactly.
Now, time has two elements. One is planning and standardization.
Yeah.
And the second aspect on time is to do with
financing.
I'll come to that fourth point. So absolutely the point. A lot of overruns happen because you did poor financing plan. Right? But the point about time is to do with construction. I was pointing to construction speed. The use of technology, right? Whether BIM, whether other forms of technology.
What is BIM? When you say BIM, what do you mean?
Building information management.
Okay.
That's to do with design and other systems.
Okay.
The point I was trying to make about construction is the use of construction technology. Very simply put, when I use the word precast, let me just simplify it. When a wall is made or a ceiling is made, right? You will have the use of steel, brick, cement, mortar, blah, blah, blah. Imagine, or a window is made. Your doors, the guy is doing carpentry, etc., etc. If the same thing was made in a factory, two things would happen. Number one, it can just be brought and fitted in, so time is saved. Number two, you'll have lower wastage. Number three, you don't need specialized labor, which is a big problem in India. Now, coming to the point that you said about financing, right, since we were talking about it. So, A, you need to plan the capital flow. B, you need to monitor it. And so, therefore, whether it is simple things like having a bank line of credit, right, even though you might be confident of sales, so that you iron out differences. Because, customer payments will come at a particular example, fourth slab. Right? But my requirement might be before or after. If the requirement is after, it is okay. But if the requirement is before, so I need to have a construction line of credit from a bank. In fact, in the ideal world, I should have what is called an overdraft. So that when I have a surplus, I put it into the bank and I save interest. When I need the money, I draw the overdraft line. Right?
Absolutely.
So that is part number one. Point number two is that a lot of developers, and I'm seeing the same mistake in the third cycle that I'm seeing in my lifetime of real estate, where they are over aggressive, right?
Over optimistic. They say the real estate, industry players are all very overly optimistic. The most optimistic industry, right? Plan
You've
less.
taken my words.
You just plan less and hope for the best.
But I'm seeing that change.
Okay.
I'm seeing that change. A, because I think people have had the benefit of this thing. B, because I think I'm seeing the younger generation who are far more educated. And they're learning from other people's mistakes. On a lighter note, maybe they're making different mistakes. But I think that's okay. But I would say this, I don't necessarily have a problem with the optimistic, because an entrepreneur, if he's not optimistic, he's not going to do it. Where I think people are missing the bus is that they're not learning as much from other people's experiences, and they're not making different mistakes.
Different
Some
mistakes,
of them are
exactly.
still making the same mistake.
Mistakes, yeah.
Yeah.
So is that why the construction delays are happening? And I know that all of this has reduced with RERA coming in, but it's still not a solved problem.
It's not a solved problem.
Right? So what should be done in the industry to ensure we have more predictable outcomes?
Okay, so let me just say this point before I get on to this. I think some of the construction delays are happening and perhaps will continue to happen in the next couple of years is because we're seeing a massive boom in construction linked to sales.
Yeah.
Right? Now, as a nation, we are short of labor.
Very surprisingly. I mean, that's one thing that,
So I think let me make that more succinct. We're short of skilled labor.
Skilled labor.
Right? And that's a topic for another time, but we're short of skilled labor.
Yeah.
So coming back to your question of what needs to be done so that we have more predictable outcomes is a couple of things. I think the old adage of under promise, over deliver should continue, right? We should not do the reverse.
Yeah.
That's point number one. Point number two is, I think, better planning. I'm sorry to repeat that point, but I think better planning has a big role to play.
Yeah.
Right? Number three is the use of technology. I don't think as a nation we are using enough technology, right? In execution, right? I am very optimistic that maybe not in the next 3 years, but certainly in the next 5 to 10 years, you will see a meaningful change. I am aware of some developers who are actually working very hard on this aspect.
Okay.
The challenge is how do you do it at scale in different geographies?
Yeah. So this brings me to the point where, I was listening to this podcast by Nikhil Kamath and he was interviewing the top real estate developers, which was Brigade, Embassy, Prestige. And they were mentioning how the role of a developer in India is very different from several other countries, where the developer does everything. Managing the contractor very closely is also the role of the developer. So why is that the case? And what is so unique about India?
So I think what's unique about India is actually a couple of things. Number one, and I empathize with every developer on this. The smaller developers probably have a bigger task.
Yeah.
Is the challenges with regulations and approvals. Right? We didn't talk about that, but a lot of time, effort, energy, and a lot of their pain comes from that.
What time of a project, let's say you're spending 100 days on a project, right? What percentage is spent actually on the approval stage?
Highly unpredictable. That's the problem. Highly unpredictable. Number one. Number two, is that there is little standardization. Things keep changing. When governments change, you have delays. We're seeing that in Karnataka.
Yeah.
Right?
Yeah.
So, but coming back to the point that you asked, why does a developer need to do a lot of things? Is because, very simply put, I don't think we have enough. I mean, when I say I don't think we have enough, I'm saying from a wish or a desire point of view, enough standardization, professionalism, and organization in the industry, right? To manage scale. Today, the real estate developers' challenge is scale.
Yeah.
Pangs of growth in a manner of speaking, right?
Yeah. It's sad that all of us are bottlenecked on labor when it comes to scale.
True.
In a country that has the highest population today.
Correct. I think that's something which
very ironical.
Ironic, and I mean, the government's trying to do something with the Skill Development Council, but
I guess if they stop their freebies, that might help a little bit. But anyway, that's conversation for a different day.
So the reason I mentioned approvals is because that's an important part of what he needs to know. If you had standardized things and to be fair, there are municipal corporations where you can get approvals quickly, and there is less corruption. You don't have things changed. It's not that it's not changing, but it's not changing rapidly enough. Okay,
exactly.
Point number one, sorry to repeat. Point number two that the developer needs to do is again the point that if there was standardizing, let me take a very simple point. You look at most markets, right? Why is it that you can do it yourself? Because your electrical socket is the same. Your switch sizes are the same. the diameter of your plumbing thing is the same.
Standardization makes all the difference.
So I'm saying a developer needs to do a lot of things
Yeah.
because there's no standard. I'm using that point as an example.
Yeah, got
Right?
it. Yeah. So let's shift gears a little bit and talk from a investor perspective, since you
Sure.
have managed PE funds and
Sure.
things like that. When you are funding when you're financing a real estate developer, what are the critical aspects you look for, and what are the red flags?
Okay, so let me perhaps talk of the red flags because those are a lot easier.
Okay.
What we look for sometimes can get, I'm happy to spend time, but the red flags. So, it depends. First, we need to appreciate when, as an investor, am I doing equity or debt? Right?
Yeah.
I'll talk largely
And how do you decide that as well?
So it depends. That really it will depend on my investor's risk appetite.
Okay.
Or let's say I'm the investor.
Yeah.
Right. If I'm a bank, my risk appetite is much lower. Right.
Yeah, of course.
If I'm an equity investor, I may have higher risk appetite, but within that, I will need to see am I do I want a stable return? In which case, stable long-term return. In which case, a very large percentage of my portfolio will be in commercial or warehousing or income yielding assets.
Yes.
I'm saying non-residential income yielding assets. Right? If my risk appetite is very high, then I'll do development risk. I might even invest at a land stage. And I've done that, therefore I'm telling you this, right? So it's a function of the risk appetite. Okay, got it. And now, if I have retail money from 2,000 investors, I know their risk appetite is not going to be at land stage. Okay. Right?
How is that structured? So let's say as an end customer, I want to finance a real estate project and I don't want to necessarily buy a property.
Agreed.
How does the structure work?
So there are two ways of doing it. One, which is something very interesting, which is happening in this country. I think a couple of people are trying to do what is called fractional ownership.
But that has to be of a completed project, right? I mean, when fractional ownership or even REITs, SM REITs for that matter,
correct,
you can only raise money for completed.
Agreed. But the point I'm trying to make is, so there are multiple options that you have. If I want to do under development, then as per SEBI AIF rules, I can only do a minimum of 1 crore. Right? Then I have to find an investment manager and who's aligned with my risk thing and give him that money. But we're largely talking about institutional capital here. Right? But if we were to talk about retail capital, that would be the kind of options that you have. Right? There is some thinking going around, how do we get individual smaller ticket sizes into under development property.
Yes.
But that's still under discussion. So, we can't talk about that right now.
Okay.
Coming to how do we choose, how do I choose a developer? We're talking about red flags.
Yeah.
Whether I'm a debt investor or an equity investor, I would be very wary of. So first thing, we must appreciate one thing. Real estate is a capital intensive business.
Yeah.
Right?
Yeah.
Capital and land are two important aspects. Since we've talked about the development piece, we'll talk about capital. The reason I said that is that if the first and single most important thing perhaps is intent.
Okay.
And then I look for surrogates in that. Has the guy taken money and returned money?
So experience, past.
Yes.
Okay.
Right? So when I said to you track record, this is one of the important aspects.
Yeah.
Right?
Yeah.
Now the important thing that I'm trying to drive home here is ability to pay back capital may have been affected, example in COVID, example during a financial crisis.
Right. Yeah.
Right?
Yeah.
How did the developer behave then?
Yeah.
That tells me intent.
Okay. Interesting. Very interesting.
Right?
Yeah.
So ability might be weak.
Yeah. Yeah.
But intent is a 0-1.
Yeah.
Okay?
Yeah.
Sorry, I'm berating a very important point.
Very interesting.
Which is at the base of giving money. It's nothing to do with real estate. It's at the it will apply to any sector.
Yeah.
Right?
Yeah.
Now, some lenders or some capital providers will say his ability may have been weak. Right? So he didn't give me money during a crisis. or he did some NCLT settlement, I'll still not give him money. That's a function of risk appetite.
Yeah.
Okay.
Yeah.
But just going back to the point, so intent, ability, track record, become important on what I would look for. On the red flags, right? One is what I told you. Two, if he is got very little equity in the business, right? Then I would not give him.
Oh, okay.
Because then he's playing on my money.
Yeah.
And if things go south, my business is not real estate.
Yeah.
My business is giving money and getting money back.
Yeah.
So I can't be taking his business risk. So I need to have him to have what is called skin in the game.
Yeah.
Now that skin in the game might be, again, some of it might come from background where I might say he has lesser equity, but he's really bothered about his reputation. So let me give you a couple of examples. Now I'm flipping to the other side and I'm saying, if I've seen a developer, with poor ability was weak, but you know what? He paid his employees not a day delay in salaries ever.
Yeah.
Okay. If he paid the lenders interest and principal on time, no matter what.
Yeah.
Right. Now, to be fair, somebody will suffer.
Yeah.
Right. Now, the vendors and the equipment providers might suffer. So, my test is to call those guys and say, was he fair with you?
Yeah.
He may have paid you late, but was he fair? So, when I get feedback which says he was by and large fair, right?
How is the relationship with the person?
I'll give you a more specific point. I've had feedback from vendors saying, you know what? He owed me 100 rupees. He gave me 102. But he gave me 6 months late. But he gave me 102.
Yeah.
Right?
Got it.
That's where the rubber hits the road. Even if he gave 100, I'll still not think. But when the guy gives you 102, then that tells you intent.
Yeah.
Right?
Absolutely.
Now, so I would definitely look at somebody like that, even if he was, because this is business, right?
Yeah.
And again, this is nothing to do with real estate.
Yeah.
This is more to do with this thing. Now, I would the red flags will come from going into a new market, right? Taking high risks of various types.
Yeah.
Having a lot of debt, which is not backed by cash flow, right? Huge leverage, red flag. Now, see, leverage per se is not bad. There are developers who have high leverage, but a very, very high percentage of that leverage is backed by rents. Now, that risk will come in a COVID type situation.
Yeah.
Right?
Yeah.
So, again, you need to be a little careful, but, nobody managed for COVID risks because, tomorrow India goes into war, God forbid. You can't, so then every business
there are
would
certain
suffer,
things you
right?
can't. What's the minimum ticket size when a PE fund is investing in a project? What's the minimum ticket size?
It depends on the size of the fund. Simple.
Okay. There's no minimum?
There's no minimum.
Okay.
So SEBI as an AIF tells you that you can't have an AIF less than 20 crores, if I remember correctly.
Okay.
And it also tells you that you can't do less than 4 investments.
Yeah. So PE funds are all structured as AIFs.
Not all of them.
Okay.
There are global funds which are not structured as.
That's true.
Yeah.
See
the word PE. I could be investing, to be fair, out of. Morgan Stanley, for example, could invest out of their balance sheet. Right? Or it may have a third party fund. Domestic AIFs, domestics are AIFs.
Yeah, the offshore funds can be anything that they want. And what's the typical return that a PE fund expects to make?
So let me just simplify this for your viewers. If I were to look at it and say that as a lender, right, I can get example between, let's say in the teens. By definition, a PE fund is taking a higher risk. And so therefore, it should look for higher returns.
Yeah, how much?
Number one. So it would typically, a PE fund would be anything between, depending on the risk. And so, for example, if they are doing rent yielding assets, right, then it is significantly lower. Right? If they're doing development and taking higher risk, then it's much higher. But in the stable return asset things, the returns will be anything between, let's say, 12% to 16%.
Okay.
Right? Okay. And for the development funds, they will be anything between 16 to 25%. And that's a pretty wide range.
Yeah.
Because of
Right,
risk
right, of
appetite and
course.
so on and
So
so forth.
once you have invested in a project that is under construction, how closely would a fund monitor the project? Do you have a team that monitors? How does that
So
relationship with
two
the
things.
developer work?
One,
How do you minimize risk basically
capital
once?
without control
Yeah,
and monitoring is a
yeah.
recipe for disaster.
Okay.
Okay, especially in this sector.
Yeah.
Right, where there is there's cyclicality. It's not anything to do with the developer per se. It's just the nature of the business, right? But more specifically to your point, you would have to monitor very closely, right?
So Ram Yadav was here from Integro for a podcast, and he was mentioning that his technology is what every developer that his AIF invests in must use.
So two important things.
Yeah.
You've touched. You're probably reading my mind. But on a more serious note, the use of technology enables two things. One, it enables ease of monitoring.
Yeah.
Number two, it enables a softer aspect, which I think is very important for any PE fund or for that matter any capital provider in any industry, which is to earn the respect of your development partner or your client. Because think about it differently. What technology is doing, it's then giving, in this example, the developer the ability to use it for other projects, which may not be by the same capital provider, or indeed for his own projects.
Yeah.
And to be fair, that's what I've done this as a PE fund. I've had to earn the respect of my development partner. And that has given me greater business and greater respect for my team, for my investors, and for all stakeholders.
So you had to build this technology, or it was freely available that you?
When we were doing it, it just wasn't there. We had to build the whole thing.
You had to build the whole thing.
But what people like Ram have is very interesting. I think it will become increasingly available. To them, it is proprietary. Right? But it enables, good monitoring system. But to be fair, technology can only do what you ask it to do. Technology is not a replacement. We must remember that.
Of course. It's an enabler.
There are many softer aspects. You can't just put technology and not meet the guy ever. That you can't do.
Of course. Yeah. So can you give us an example, Kuldeep, where you have invested and lost money, and invested and made more than you expected to make?
Yeah, I think there are enough examples of both.
Okay.
So I won't take names because I think that takes away the purpose.
Yeah.
Both people that we invested. So where we invested and lost money was a situation where it was a great name. The market was not so. The market that we invested in was not so great. The developer was outstanding, but he had very little skin in the game.
Okay.
So I think with the benefit of hindsight, whilst it was 1% of our fund, and we invested with that developer, knowing that we did not, he had very little skin in the game, that we wanted to do other things with that developer, which did not happen.
Okay.
But I think the learning from that was, it doesn't matter if the name is great, if the guy doesn't have skin in the game, there will come a point in time in which you could lose money. Right? Because it was an equity investment, there was nothing that he had to do. We did other things to try and minimize our loss. But that's a different other thing. So that's point number one. I think lesson from that is more important than... I think the lesson was skin in the game is very important.
Yeah.
Right?
Absolutely.
There were other things, but we'll talk about that another time. Where we ended up making much more than we expected was two types of situations with the same developer. One was we did a bunch of projects with that developer, and we were investing in land, and that land aggregation was taking longer and became more complicated. Proactively, that developer told us, Kuldeep, this is running into a problem. I think both of us are going to lose money. I am stuck. I can't get out. But I would like to give you something else.
Okay.
So right. So we ended up.
Again, the intent.
Absolutely right. And why I talked of intent is because in equity investing and in land, that is perhaps more important than anything else. Now, we didn't end up making more money in this example, which I'll
Okay.
come to in a bit, but we ended up not losing money.
Yeah.
So we transferred into another project with the same developer. He gave us a couple of projects, right? We chose one, and we ended up making a lot more money than we would have ever made in that project.
Oh, okay. Got
Okay,
it.
so that's point number one. Point number two is that with the same developer, we had a situation where we needed to exit within a certain time frame, and the developer kept telling us, "Don't exit, right? You'll make more money."
Okay.
That was both these projects, incidentally, were in Bangalore or in the region of Karnataka. The first one was outskirts of Bangalore. The second one is one of the return that market has seen in the last 10 years has been the highest probably in the country, or near maybe not in the country, but certainly in South India, I can say that. Okay. And we ended up making a lot more money. Okay. Of course, it's not just that the developer did it. We spent a little bit of time doing some research. And so we said, listen, it makes sense to hold even beyond fund life.
Okay. Wow.
Now that's a difficult call, right? For an investment manager. Really difficult. So we ended up we made like 3.5, 4 times our money.
Wow. That's awesome.
Yeah.
So Kuldeep, before we close, why don't you tell us what work you are currently doing and how you have used the lessons you have learned across all of this work you have done previously in your current role?
Right. Okay. So what we do now is we run a small firm called ASK Strategies. We're about, half a dozen people right now, but we use a lot of project specific people for the kind of work we do. We do 3 things. Number one, we do capital solutions, not just, providing capital, because often people come to us and say, I need money, right? So let me put it this way, about 70% of what we do is real estate, right? Within the real estate, since we're talking real estate, I'll focus on that. We do solutions around capital. By that, I mean, we help people raise capital from the right sources, right? Not just a cookie cutter kind of approach, right? We help developers with the right partner, the right structure, the right amount of capital, right? Or we tell them that you should not do this, you should do this instead. Rather than just do the traditional approach of saying, okay, let me introduce you to people, because there's no real value add. Okay, so that's one. The second thing we do, which is we do land solutions for developers, both on divestment as well as investment. Okay, but the bulk of what we do over the last 3.5 years that we've been in business since I quit a corporate job is we do 2 or 3 types of things. We do growth capital management with not just strategy but implementation.
Okay.
So I put my money and my time where my mouth is.
Okay.
And my team does the same.
Okay.
Right.
Okay.
And the second thing we do in the same role that we do is turnaround solutions. Okay. Turnarounds will typically happen for landowners predominantly, for smaller developers, for stressed developers, so on and so forth.
Okay.
The growth capital is where people have an aspiration to kind of grow from, let's say, where they are. Let's say they're at 100, 200 crores of turnover.
Okay.
And they have a desire that they want to get to 2,000 crores in the next annual sales, just to use a metric, in the next, let's say, 5 years. Now that's a massive jump. Right? So first we tell them that, real estate is a marathon, not a 100-meter dash. Right? But the point is, how do you then stabilize the ship or help them grow, right, to whether reach that metric or a revised metric?
Okay.
That means every solution, right, from governance and risk management, right, to sales channel partners, setting up their people, to hiring solutions, finding them people, right, to partnerships.
Okay.
including land. That's why these other pieces help.
Okay.
Right?
Okay.
We can give them outsourced CFO services.
Yeah.
But that's patchwork.
Yeah. Yeah.
So we are actually we're doing it in a very small way right now. We are basically helping people achieve their aspirations.
Okay.
Right?
Okay.
On the side, we're trying to figure out if I should do what I started 20 years ago.
Okay.
Which is to put a capital platform in place. But that's at early stages yet.
Okay.
Okay. We're trying to find a niche within that platform that has something which is different. And last but not the least, I think that different needs to have a little, for want of a better word, a purpose in it.
Yeah. I
some
think
soul.
we're all looking for that purpose and that soul. But thank you so much, Kuldeep. It was a very enlightening conversation.
Pleasure's entirely mine.
Yeah, thank you so much.
Thank you.
Hope you have been enjoying our podcast. At Property Angel, our mission is to make real estate affairs safe, simple, and efficient. And that is why we bring you these podcasts, to empower the consumer so you have the right information. We are an asset management company. You can outsource your landlord responsibilities to us, including tenant management aspects, maintenance, rent collection, financial management, and all of that. If you have any such requirements, please do reach out to our team. Please do also like, share, and subscribe. If there's anything specific you would like to listen to, please do leave it in the comment box below. Thank you for tuning in.